Okay guys, in this video I'm just gonna really quickly go over what is in this Excel sheet. That is what we did in this Excel. And I'm not gonna like redo whatever we did in the class. I'm just gonna go over the problem all the way until the finding the line of credit and the special dividend so that the balance sheet is balanced, so that that's the end of the financial plan. And then after that, I'm gonna take a quick look at the homework assignment posted on Cengage. Okay, so so this is the income statement, this is the balance sheet, these are the current data. We have the input section down here, and down here we have the forecast scenarios, right? So we have different scenarios. So I don't really have to work with these because all of these will be useful when we have the free cash flow done. So I'm just gonna hide these, saying like hide. Then they are hidden. They're hidden. Sorry. So, and then I'm pretty much gonna refer to just the input section. So before I start, I just have to copy and paste all the row items here. That is like here. I have the balance sheets, and then I have the cash all the way down to the end. So this is the cash. And I'm gonna put it under column D because column D is the 2021 number that's aligned with the input section. So I'm just gonna put them here. And then I'm gonna paste the values and number formatting so that if there's any functions, they are not like included here. So I'm gonna remove this border. That's the balance sheet. Then I need the income statements. That is here. Let's put it like here, right? So I have the income statement. There's a little gap here, so I have the income statement here. I think I can scooch down a little bit. So let's say I scooch down one more row so that balance sheet starts at 101, and then scooch back one row so that income statement starts at 124. And then I'm ready to put down the years. So the year of the column D is 2021. And then it's gonna be 2021 plus 1 for the upcoming year. And then if I keep going, I'm gonna get all the way until 2026. And then I can go down to get the income statement numbers of the base year. So the income statement numbers are here for 2021. So I have the numbers starting from the net sales, and I also just paste the value and number formatting so that I have net income. And then below net income, I need common dividends, right? And the common dividend of 2021 is gonna be 60, I think, which is under other data, which is here, right? So 60. So I'm gonna put it here, and I also just paste value and the formatting. So it's not gonna make a difference, but it's just to be safe. Okay, so I have the base here, I have everything ready. And then what I'm gonna do is I'm gonna start predicting. I'm gonna, you can start whichever row you want. But what I'm gonna do this time is that I'm gonna follow the order of this input section. So I'm gonna begin with sales, then COGS, depreciation, other expenses. Then I'm gonna jump to the balance sheet to do cash, accounts receivable, inventory, PPE, accrual, accounts payable, and accruals. And then I'm gonna fill in the other items. Okay, so let's say the sales is gonna grow at 10%. So it's gonna be previous number times 1 plus the assumed growth rate. Once again, if it's confusing to you why I use a growth rate rather than like anything else, or why I use a percentage of sales rather than anything else, it's pretty easy to tell from the assumptions that says here, that COGS over sales, right? That's basically saying I'm assuming in 2022 this ratio will be 78%, So as a result, my 2022 COGS will be 78% of the sales, right? So if I say it's a growth rate, it's pretty straightforward. It's just gonna grow at 10%. So when you're looking at what to predict for the given inputs in the model, all you need to do is just to read whatever is there for the role title so that you know what's going on. So for COGS, again, I'm gonna use this 78% multiplied with sales, right? And depreciation is gonna be a certain percentage, 10%, right? 54, 10% of net PP&E, right? So I'm just gonna multiply this number with the net PP&E, which is row 108. And then the next one is gonna be other expenses, 10% multiplied with sales, right? So it's also like that, right? So I have predicted all these. And I'm ready to jump to the balance sheet to go from like cash, right? So cash is, if you look at this number, it's this ratio. It's also 2%. It's also over sales, right? It's also a percentage of sales. You also have to use the forecast 2% multiplied with the sales, right? Which is E125. Okay, I'm gonna keep this in mind, E125, so that I don't have to scroll up and down again and again. And then accounts receivable is gonna equal to here 10% accounts receivable over sales multiplied with 125, right? E125. That's again still it's the sales number. Inventory it's gonna be 58, which is the assumption of inventory over sales multiplied with E125. So then the total current assets is just gonna be the sum. But you know, since I said I'm gonna just do everything with an assumption first, I'm just gonna say, okay, net PP&E over sales is gonna be 40% times sales number. Okay, and then we know accounts payable, that is 4% times the sales number, and then accruals, it's gonna be 8%, right? So accruals, it's gonna be 8% times sales, right? So they are all assumed to be a percentage of sales. And that's pretty much it all the way until here, right? Then we have a tax rate, we have some cost of debt, we've been through this, we have the preferred stock, cost of equity, the additional rate on line of credit versus cost of debt. And then we have a growth rate of dividend, right? So we can predict the common dividend of the upcoming year using the dividend growth rate. So that's gonna be this multiplied with 1 plus the 5%, right? The forecast. Okay, so I got 63. All right, so these are pretty much everything that we know given the assumptions and the setup. Right, so then what we can do is that put things together and make some additional assumptions. So for example, let's say short-term investment is gonna stay to be 10, right? This is what we assumed. And then let's calculate the total current assets. It's essentially just gonna be the summation of these, right? And then the total assets is gonna be total current assets plus the total current assets plus the net PP&E, right? So these are the assets, 3970, that's the total. And then let's also say notes payable is gonna stay. Let's say total current liabilities will be the summation of the three. Long-term debt is gonna stay the same. Then total liability is gonna be this plus this, right? Total current liabilities plus long-term debt. And then again, let's say preferred stock is gonna stay. Common stock is gonna stay. Then it's the retained earnings, right? So how do you calculate retained earnings? Retained earnings is gonna be the retained earnings of the last year plus the net income of this year minus the dividend that you're gonna pay, right? So that's the retained earnings. And then the total common equity will be common stock plus retained earnings, right? So common stock plus retained earnings. And then total liabilities and equities will be total liabilities 1330 plus preferred stock plus the total common equity, right? So that's the that's what we did. And then the EBIT is gonna be the sales minus all the operating expenses added together. So I just add all of these. I got 440. And then interest expense is the tricky one, or the more complicated one, because we have like a notes payable as well as long-term bonds. And then later we're going to add another tier of debt, which is line of credit. So the interest expense is a little complicated to calculate. So why don't we just insert another couple of rows, and we say there's interest from short-term debt and there's interest from long-term debt, right? So the interest from short-term debt is determined by the balance of short-term debt multiplied with the interest rate, which is here, right? And then the interest on the long-term debt is going to be the interest rate of long-term debt, which is here, multiplied with long-term debt, which is here. Okay, once again, if you have any trouble, just pause the video and try to do it on yourself. However, you may have different row reference as mine. You just make sure you're referring to the long-term bonds, interest rates on long-term bonds, as well as notes payable and interest rate on short-term debt. Okay, and then the interest expense is going to be this plus this. That's the total interest expense. And then the earnings before tax is going to be EBIT minus interest expense. And then the tax is going to be pre-tax earnings multiplied with the tax rate, which is 25%, right? And then net income before preferred dividends, it's going to be this minus this, right? Pre-tax earnings minus tax is earnings. Preferred dividends is going to be the preferred dividend rate multiplied with the preferred dividend level. Balance, preferred stock balance. So it's gonna stay as 7. And then the net income after preferred dividend is gonna be the difference between these two numbers, net income before preferred dividend and preferred dividend. Right? So I got 275, and then the total liabilities and equities is 3882. This is 3970. There's a gap of 88, right? So this basically matches the number we got in class. And then the problem is we don't know what's the financing deficit or financing surplus will look like in the future. So what we have to do is that we have to incorporate a line of credit. If there's a financing deficit, we have to incorporate a special dividend if there's a financing surplus, right? So that's what we said we want to do. So what I'm going to do is I'm going to figure it out here, and then I try to put it back in the balance sheet and income statement. So I have financing deficit or surplus. So the first one we need to know is the increase in assets. So it's going to be the assets number, this, minus the asset number of the previous year. So that's 360, I suppose. And then I need to calculate increase in spontaneous liabilities, increase in debt financing, increase in equity financing, and then increase in retained earnings, that is, internal financing, right? So if we do that, we just have to calculate each category and then minus. So this kind of got a little messy here. In the class, I was just putting the change in the cells. So I refer to two cells added together, and then I minus the same row in the previous year. However, this caused maybe some confusion, I'm not sure. But I'm gonna do something else here. So in the sense that I'm first gonna calculate spontaneous liability for each year, and then I calculate the increase in spontaneous liability. And then I can calculate the debt financing. Then I calculate increase in debt. I can calculate stock financing, and I calculate increase in stock. And lastly, there's the net income minus common dividend. Okay. So what's the balance of spontaneous liability? It's going to be the accounts payable plus the accruals, right? This one in this year. And in the previous year, it's going to be like the same two numbers in the previous year. So make sure it's a summation, right? It's not a subtraction. So then you subtract to calculate the difference, right? So I mean, in here, it has to be the total of the two. And then here, you have to calculate the change, the increase, right, over the years. And then for the debt, it's the same thing. We have a long-term debt and a short-term debt. So short-term debt plus long-term debt, right? So 670, and the change is 0, right? So this minus this, it's 0, okay? And then I have a stock, which is common stock, and I have a preferred stock. I have a preferred stock, I have common stock, that's the two. I got 600. In the previous year, it's also 600. And then this minus this, it's again 0. And then net income minus common dividend is going to be like here, net income minus the common dividend, right? So that's the 212, right? So you don't need this from the previous years, okay? All right, so then what we can do is we can calculate the difference between the two, increase in assets minus the increase in financing. So that's going to be the increase in assets minus the increase in spontaneous liability minus the increase in debt minus the increase in stock minus the increase in common net income minus common dividend, right? So I have 88. And then the financing deficit or surplus is going to be determined by this number, the increase in financing that is not enough for increasing assets, plus the previous balance of line of credit, right? Because you have to pay the line of credit back during the year, then raise additional 88. So I have to add to the previous line of credit. The issue is I don't have the previous line of credit in the balance sheet or the income statement or anywhere. So before we really figure this out, we just have to put line of credit and special dividends in the balance sheet and income statement. So the first, line of credit is here, line of credit. So in the previous year, it's 0. In this year, it's something we want to put, so we can leave this blank. And then it's the special dividend. So of course, in this year, it's 0. So in the current year, we don't know what to put yet, right? So I want to add a space between the two. So just add a space. So the special dividend, since there is special dividend or there's potential special dividend, the retained earnings has to be updated, right? So now we are only using previous retained earnings plus the current net income minus the current dividend, and then we just have to minus the current special dividend, right? So both dividends should be paid, and then the line of credit, if there's a line of credit balance right here in the last year, we will have to pay some interest expenses, right? So we have interest on short-term debt, interest on long-term debt, and then let's say there's interest on line of credit, right? So the interest on line of credit is determined by the previous line of credit balance multiplied with the rate on short-term debt plus the additional rate on the line of credit, right? So it's just, it's just one way to define the rate on line of credit. I can just say it's 10%. It's either way, it's fine. It's just to make it a little bit more complicated. But the idea is still using the balance to multiply with the rate, okay? So that's the interest on the line of credit. And then I just need to incorporate that into the total interest expense so that, when I have some line of credit, I'm subtracting the interest of that in later sales. Okay, so I have the line of credit. Then I also just want to make sure that total current liability incorporates this line of credit. So it's here, so it's good. All right, so I think that's pretty much it. So what I can do is I can say the financing deficit is going to be the additional deficit that we're going to face, plus the previous line of credit, because, we are missing that. And then we got 88, okay? And then we can decide whether we want to use line of credit or special dividend to balance the balance sheet, right? So if this number is positive, it means we have a deficit, so we need some line of credit. Otherwise, the line of credit is 0 because we don't need it. So this is the formula for that. And then if this number is negative, it means we have a surplus, right? Then we will need some special dividend. Otherwise, it's also a 0, right? So in this case, it's going to be 0. But if this number is a negative number, again, which means we have some surplus, then we're going to pay a special dividend. Okay. So in the balance sheet, the line of credit equals to the line of credit roll, and the special dividend equals to the special dividend roll. Okay, roll. Okay, so that's the numbers, I think, right? All right, so what we can do now is that we can check if the balance sheet is balanced for the first year. It is, so we are like probably correct. And then we just have to select everything, copy it, right, the whole thing, and paste it to the next year. If you look at the balance sheet, it's also balanced. Look at the line of credit, it makes sense. It's a positive number, and here you have 0 special dividend, and everything is calculated the way it is supposed to be. So it seems we are fine. So we are going to keep going, paste it to the next 3 columns. And then, as you can see, we have the special dividends, line of credit, and the balance sheets are all balanced, right? So here and here, right? So these 2 rows, they are the same, right? All right, so that's pretty much it. That's everything with the what we did in class. Then I just want to take a look at this problem, the forecasting financial statement problem. This is what we did, I mean, the same thing as what we did in class. Given that it's only asking for 1 year of analysis, so we can take a quick look at it. So it's asking me to download the data. I'm gonna open it up. Okay, so if you look at this, you're gonna see the model. So first of all, we need to calculate the historical ratios. It's asking us to calculate cash over sales. So here, right? So I'm gonna put $signs in front of that so that it's gonna be faster if I do this. So the second one, I'm copying this and pasting it here. So if you look at that, it's accounts receivable over sales, which is B42. And then it's gonna be inventory over sales, copy and paste it. Fixed assets over sales, copy and paste it. It's gonna be the fixed assets number over the sales number. Okay. And then the same thing, copy and paste it for accounts payable over sales, copy and paste for accruals over sales, and then copy and paste for expense over sales, copy and paste for depreciation over sales. However, this is wrong because I need depreciation over fixed assets. I'm just gonna drag it. Where's fixed assets? Voila, it's here. Okay, 8%, and there's no other assume the ratios. And then for 2022, the ratios will be the same as whatever in the previous year. So basically status quo, I'm just saying they're the same. So it equals to that number. I just, make sure, in blue cells, make sure you try to not hard code any numbers. For the ones I have seen for this homework, a lot of you do actually just like put in hard code numbers. I know it's an easy number to put in, but for the purpose of practicing some Excel, I really hope you don't do it. And then the this ratio is like this ratio is like this, and the growth rate is up here. That's here, sales growth rate 8%, right? So that's the number. And then the dividend growth rate is also a growth. It equals to the dividend growth rate, which is 9%, right? Okay, so that's pretty much like most of it, right? All the assumed ratios. And then what's gonna happen is we need to first do a preliminary forecast. where we do not include any special dividend or the line of credit. And then there's a final forecast where we include special dividend and line of credit, right? So let's just still do the sales number first. It's gonna be sales multiplied with 1 plus the growth rate, right? So it's gonna grow at 8%. It's growth, right? It's pretty clear, set there. So it's gonna be this number, and then it's gonna be the ratio multiplied with sales, right? So I'm gonna again put a $ here so that it's easier when I copy and paste. So I got the these numbers, and then all I need to do is to like maybe drag it, I guess. So the let's just copy and paste, and then I want to paste formulas. Okay, so the number formatting is reserved, so that I don't have to change anything. So as you can see, it's this percentage times sales. Again, it's wrong. I just need to change it to fixed assets. Fixed assets is here, right? 40% times sales, right? Okay, so I have the three things. The EBIT is going to be this minus this minus this. I got the EBIT, and then it's the interest rate on the long-term debt. So it's saying that interest rate on the long-term debt will be interest rate times average debt during the 2 years. So I can say average debt. The long-term debt is here, row 31, and the previous one, row 31, right? These two numbers, right? Multiplied with the interest rate. So interest rate on long-term debt is up here, 11%. I'm gonna hit enter. So I got the interest expense. So EBT is this minus this. Oh, sorry, this is the line of credit, right? Interest expense on the line of credit. So it's gonna be the interest rate on the line of credit is 12%, multiplied with the previous line of credit, last year's balance, right? I got 0, of course. I mean, I see some of you hard-coded 0. The numbers is correct, but it's better if you don't do it. So EBT is the difference among the three. I got this. Then tax will be this multiplied with 25%, which is a tax rate up here. And I got that. The net income will be EBT minus tax. I got the net income. The regular common dividend will grow at this growth rate, 1 plus 9%, right? And the special dividend is just gonna be 0, hard-coded in the preliminary forecast. And in the addition to retained earnings is gonna be net income minus the regular dividend minus the special dividend. So I got the addition to retained earnings. And then the I'm just gonna, here I have a percentage of sales. I'm gonna copy this and put it here and saying only the formulas. Okay. So if you look at this number, it is this rate, percentage of sales, right? Multiply with sales. Okay. Then copy and paste again, only formula. Copy and paste again, only formula. Okay, so that's the, again, so it's 8% times the sales, right? And copy and paste again, and then only formula. I got 40% times sales, right? And then copy and paste again, only formula. So I got 5% of sales. Copy and paste again, only formula. I got 4% times sales. Okay. All right. So then I can put them together. So total current assets is just, the three added together. Total assets, it's gonna be this plus this, right? So these are the total assets. And then the line of credit in the preliminary forecast, I'm just gonna call it 0. And then the total current liability is gonna be the total of the top three. The long-term debt is gonna carry over. So the total liability is total current liability plus long-term debt. And then the common stock will carry over. The retained earnings will be the previous number plus the addition to retained earnings, which is the last row in the income statement. And then the total common equity is going to be common stock plus retained earnings, right? So So total liabilities and equities will be the total liabilities, row 32, plus total common equity, right? So there's no preferred stock, so that's the 2. So if you look at these two numbers, there's a gap, right? Which is supposed to be filled by the line of credit, right? So then we just need to figure things out down here. Figure out the financial deficit or surplus. So you just, follow whatever it's saying here. So the increase in spontaneous liability, I just first need to put together accounts payable and accruals. So accounts payable is here, plus accruals is here, minus the previous number, right? So accounts payable of this year plus accruals of this year minus accounts payable of the last year plus accruals of the last year, and I have increase, right? Plus increase in long-term bonds and common stock. It is 0, but let me still do the formula. So long-term debt is here, plus common stock is here, right? Minus the previous year's numbers, this one plus common stock, so it's a 0, and plus net income in preliminary forecast minus regular common dividend. You do not subtract special dividend, because if you subtract special dividend, it's going to be a circular reference problem once again, right? Because you are using the special dividend to calculate a number that's potentially going to be used to calculate your special dividend. Okay. All right, so F50 is the dividend income minus regular common dividend. It's going to be the retained earning. Then I want to subtract the line of credit, previous line of credit. Previous line of credit is just here, it's 0. Okay, I put 0 here. And then what's going on here is that it's a little different from what we did earlier. But eventually, mathematically, or if you look at the algebra, it's going to yield the same number. So just don't worry about it. Either way, it's fine. And the idea is that line of credit is going to be part of the financing deficit or surplus you calculate. Okay. So the increase in financing is going to be the sum of these. Okay. And the increase in total assets is going to be the difference between the total asset here and the total asset here. So you take the difference, right? And then the amount of financing deficit or surplus is the increase in financing minus the increase in total assets, right? So in this case, if it's a negative number, it means it's a deficit. But in the way we did it in the Excel earlier, it was positive if it's a deficit, right? So that's why you minus line of credit in this case, but you plus line of credit in the other. So I got this negative number. And then what I'm going to do is use the if statement. If this is less than 0, then it is going to be the negative of this number. It's going to be a line of credit. Otherwise, it's 0. And then if this number is positive, then it's a special dividend. So it's just going to be this number. Otherwise, it's 0. Okay, so that's the numbers, right? And then in the 2022 forecast, what can be done is essentially I can copy this and put it here. As you can see, this number will still be the same. The only difference will be the addition of line of credit as well as the interest on the line of credit, right? So, but once again, let's do this. So I'm just copying the formula from this cell, right? So copying the formula from this cell to this one. But I'm referring to the same, to this sales. I should have done this, but the number does not change, right? So for now, it's gonna be changed to 0, but once I fill in the net income, the sales number, the numbers should be the same. Okay, all right. So this is this can be copied. This is the summation of that. And again, this is gonna be copied and pasted. Again, it's the previous year sales times 1 plus the growth rate. Okay, so once it's done, as you can see, this makes sense. It's the same number. The fixed assets, it's the same thing. It's gonna be a percentage of the sales number that we got down here, right? A percentage of sales. And then this is the same thing. I can copy and paste. I got the total sales, sorry, total assets. Once again, the number does not change. And down here, I'll copy this and paste it here and paste it as a formula. Copy it, paste it here, paste it as a formula. So if you look at that, it's going to be a percentage of the sales. Here, percentage of the sales. It's the same thing. But now the line of credit is going to be the same as this number, right? And the total current liability is going to be a little higher. And the this will stay the same. It's always going to be the carryover value. And this number is going to be the total of the two numbers and add them together. And again, this number is going to be the carried over value. And in addition to retained earnings, it's going to be the new retained earnings, right? So I'm just going to say it equals to retained earnings plus the so-called addition to retained earnings, which is the last row, right? Okay, so the number is a little smaller than before, than this one, but it's completely because I haven't filled in the net income number. So and then this can be copied and pasted. It's just common stock plus retained earnings. And this can be copied and pasted. That's just total liability plus total common equity. Okay. And then for this one, it's going to be the percentage of sales times the sales. Again, copy and pasted. It's going to be a percentage of sales times sales. Again, EBIT can be copied and pasted. And this is going to be the average of the two debt. I'm still just going to copy this formula and put it here. If you look at that, it's the same formula, but other than this one, I'm going to drag it over. Once again, the numbers are not going to change. I'm not going to pretend that it's going to do anything, but this is the correct way to put in the formulas. But it does not matter in this specific question. Okay. And then the interest expense multiplied with line of credit, that's going to be the same thing. Still use the previous year's line of credit times the interest rate. Okay, and then the EBT will be this, tax will be this, net income will be this. Okay, so the tax here, apparently, the cell reference is wrong. I have to drag it back, okay, during the copy and paste. Okay, so that's the tax. What else? Depreciation and amortization. So the depreciation should be a percentage of total assets. Okay, here. All right, so as you can see, it's the same number. There's no difference. And this is also the same thing. I just need to copy and paste. I use previous dividend times 1 plus the dividend. And now the special dividend has to be equal to this number. Okay, but it's, again, it's 0. It doesn't matter to this specific question, but it's the right way to do it. Once I fill this in, if you look at the total liabilities and equities and the balance sheet assets, they're the same. So the balance sheet is actually balanced. Then what I'm gonna do is that I'm gonna take a go. This is a 4335.93. I'm gonna try to put it in the in the web page and see if it's the correct number. All right, so this is what I just put in, 4335.93 and 0 special dividend. So it's correct, right? So yeah, so I think that's how you do it. And then assume the sales growth rate to be 4%. If I assume the sales growth rate to be 4%, and let's say if I switch back to the Excel, what I can do is I can change the sales growth rate, this number, to 4%. And then if you scroll down, you're going to see the financing deficit to be 0 and this special dividend to be 5338.16. I'm copying that. And the balance sheet is still balanced, right? So what I'm going to do is that I'm going to switch back to this, right? So if you look at the numbers I put in here, 5338.16 plus and 0 line of credit. So they're all like correct, right? So that's how you do it. That's how you come up with the line of credit and special dividend according to this textbook. And again, we mentioned that there are like more than one possible ways to achieve that, but this is what we want to know at this stage of your career. Thank you.